It's not a super busy week for data, particularly in the U.S., but we have CPI coming out on Friday. I think headline CPI will probably stay constant at 2.9%, which is well above the Fed's target, though that's not the measure the Fed's looking at. What's really interesting about that, I think, is that we just got average hourly earnings last Friday, and that came in at 2.7% again, which means that you'll have headline inflation running ahead of average hourly earnings. And so actually workers are going to be falling behind, which is never a good thing for the economy. So even though we've had this incredible GDP growth, most people aren't really feeling it in their pockets.
I feel like we didn't get the bang for our buck for the recent employment reports because of those revisions. If we had known on those previous two reports that they were going to be revised 59, whatever it was, those would have been unbelievable reports that came out at that point. So the 154, which looked disappointing, you factor in those revisions, I don't know, I felt like we didn't get the bang for our buck for how strong in this late cycle economy. It's incredible at 3.9% to still be adding that many jobs, isn't it?
So it is incredible, although I think that the quality of the jobs is much more important than the quantity. So I tend to ignore that headline figure, absent of some huge aberration anyhow. I think much more important is the wage growth data. And it turns out that we're adding most of our jobs in the sectors that produce the stuff that we're consuming, which is far and away services. And service-producing jobs tend to be really low-wage, low-hour jobs. And so even though we're adding tons of jobs, even this late in the business cycle, and that is impressive, we're adding them kind of at the bottom of the pay scale. And so on average, I think Americans aren't feeling like this recovery is really benefiting them a whole lot. And I think that has social and political implications.
But Megan, I'm going to push back on that a little bit because we also saw, big numbers again in manufacturing. 37,000, I believe, last month.
500,000.
Yeah.
Since, yeah.
So, I mean, those are typically higher paying jobs. Are you saying that services is, having a more outsized effect than those jobs?
Yeah, that's right. And you chose the highest paying sector, really, and that's manufacturing. And last month's data was great for manufacturing. And for the past couple of months has been okay. But overall, we're adding many more services producing jobs. And so that is overpowering upward pressure on wages for manufacturing and construction.
Yeah, I'm going to go to earnings because we can talk about it for maybe one more week. We're about 80% through the earnings season. And to the point about the breadth of the market, you see it in earnings results. I mean, the S&P is only trading at 17 times 2018 because we have 27% earnings growth. But to the breadth point, value stocks have had almost the same earnings growth as those high-flying tech stocks. Now, that may mean that tech's run of outperformance might wane a little bit, but it's tremendous support for the broad market, and it's also indicia that the economy is doing just fine.
And we've been hearing a lot about that, this idea of maybe we're going to start to see this great rotation into value. Are you suggesting that that's where investors should be focusing more of their money right now?
I think that certainly tech stocks are a little bit stretched on a relative basis, but it's the breadth of support for the whole market that's quite important at this point. And also the one thing we're seeing lately is a little bit of a rotation away from small caps. Remember, small caps get a little bit of a headwind from rising interest rates because they're quite leveraged. So as much as anything, if you're going to stay on the small side, you need to focus on quality. So it may not be a deep value rotation, but a little bit of a quality play to make sure you're still getting the earnings growth.